Okay, it's done. Are you finished to scan the QR code your attendance?
Yes, sir.
Yes, I
Okay,
believe it's yes.
so let's we start about our learning in capital market analysis. So wait a minute. Ah, is it clear? Uh, okay. Our
Yes.
subject is option in capital market, and this is introduction in capital market analysis. So, the understanding option can enhance your investment toolkit. Why? Why enhance your investment toolkit? Because understanding stock option is very crucial because the instrument offers strategic flexibility for speculation, hedging, or generating additional income, and with relatively small capital. The premium option provide high leverage to control a large number of share while limiting risk for buyers to only the premium paid. Option also act as insurance for portfolio. For example, a put option protect against losses if stock price fall, while allowing traders to earn premium by selling option such as through cover calls. Okay, okay. So, uh, what are option? So there are some definition and some strategies as like the call option, put option, and key term in option. So the definition is contract convey the right, not the obligation to buy or sell an asset. This a very unique feature provide flexibility to investors. So the option market reflects expectation for future volatility and prices, aiding more informed decision making. However, their complexity requires deep understanding to avoid strategic errors, especially for option sellers who face higher risks. By mastering option, investor can maximize profit, manage risk, and capitalize on opportunity in various market conditions. So this is the example about the option. For the first example is call option. Okay, if stock X trades at $50 and investor buy $55 strike call, expiring in 3 months for $2 premium and break even $55 strike plus $2 premium is equal if $57. And profit scenario, if stock X rise to $70, the call buy gains $13 per share or $70 minus $55 minus $2. Low scenario, if stock X stay below $55, the buyer loses only $2 premium. Advances strategy, cover calls, sell calls, and own stock to generate income and call spread, limit risk by buying a call and selling a higher strike. So the conclusion of the call option example is call option provide investor with a strategic tool to profit from anticipated stock price increase while strictly limiting downside risk. In this example, an investor purchased a $55 strike call option on stock X, currently trading at $50 for a $2 premium, establishing a $57 break-even point, stick price plus premium. Should stock X surge to $70, the investor realize $30 per share profit or 70% stock price minus 55 strike price minus 2 premium. And demonstrating the option leverage upside potential. Conversely, if stock X remain below $55 at expiration, the maximum loss is confined to the initial $2 premium. Okay, highlighting the divine risk nature of long call position beyond basic directional bets. Call option enable sophisticated strategy like cover calls and bull call spreads. And This example underscore how call option over control risk exposure to price rally while providing opportunity for both capital appreciation and income generation in an investment portfolio. And the combination of limited risk, high leverage potential, and strategic flexibility make call option particularly valuable for trader anticipating bullish move in underlying asset. Because in call option is the right to buy an asset at a specific price. Investor use call to bet and on price increases. So investor primarily use call option to speculate on rising prices, benefiting from leverage that allow significant upside potential while limiting losses to the premium paid. And additional calls serve hedging purposes, such as protecting short position or generating income through strategic like cover calls. However, their value is influenced by factors like time decay, implied volatility, and the underlying asset price movement, making them a powerful contact instrument for a strategic trading. So the call option is a financial derivative that give the buyer the right but not obligation to purchase an underlying asset and predetermined strike price before or on expiration date, requiring the seller to fulfill the transaction if exercises. Okay, and the second example is about the put option. So based on the put option, over investor a strategic way to profit from declining stock price while strictly capping potential losses at the premium paid. In this example, so look at your example in your monitor. Purchasing a $50 strike put on stock X, trading at $55 for $2 premium establishes a $48 break-even point or 50 strike minus $2 premium, meaning the stock must drop below 48 to generate profits, with maximum gains occurring if the stock plummet to zero, theoretically, yielding 4,800 on $200 investment for 100 shares. If stock X falls to $40, the investor needs $8 per share or $50 minus $40 minus $2 premium, translating to a 400% return on the 200 premium, while the worst case scenario, if the stock stay above $50, limit the loss to just the initial $2 premium. Beyond bearish speculation, puts serve as portfolio insurance, protective puts, volatility play around earning even or even income generator will show through selling carry higher risk. The trade-off involves time decay, eroding the option value as expiration near and potential early exercise if the put goes deep in the money. But the divine risk profile, maximum loss equal premium paid, makes puts particular attractive compared to risky strategy like short selling, especially in volatility or declining market where they provide leverage downside exposure without margin requirement or unlimited loss potential. So, best definition of put option is the right to sell an asset at a specific price. Put are used to profit from price decreases. So the put option is derivative contract that give the holder the right but not obligation to sell an underlying asset and predetermine strike price before expiration or effectively serving as a bearish bet or portfolio insurance. When investors buy puts, they profit if the asset price fall below the strike. Okay, after accounting for the premium paid, while seller collect premium but face obligation to buy the asset if assigned it with features like limited risk for buyers, leverage downside, uh, exposure and time sensitivity, value decay, and then uh, puts enable strategy ranging from protective hedging, for example, shielding stock holding from declines, to speculative play on market downturn, or even income generation through premium writing. Or for the example, is cash secure puts for potential stock acquisition at lower prices. So the types of option is there are several uh, types of option. The first one is equity option. The second one is index option. And the third one is ETF option. And the next is future option. And the last but not least is exotic option. So, option provide uh, several types based on their underlying asset, each serving different market needs and strategy. Equity options are tied to individual stock, allowing investors to speculate on or hedge a specific company performance. Index options track broader market indices, for example, S&P 500, providing exposure to overall market movement without owning diversification through exchange trade funds. Future option grant the right to buy or sell future contract, commonly used in commodity and currency or for leverage position with something like the expression flexibility, lastly exotic option. In exotic option, for example, is barrier, binary, or Asian option, feature non-standard payoff or condition, catering to specialized hedging or speculative needs. Together, these option types enable tailored strategy across equity, indices, sector, commodity, and then structure product, balancing risk management with profit potential in diverse market condition. And then this is the option pricing. There are some key factor in option pricing. The first factor is intrinsic value. So the intrinsic value is difference between asset price and strike price. It represents immediate profit. And the second one, in the key factor in option pricing is the time value. Why time value? Because value from time remaining until expiration. It decays as expiration nears. And the third one of the key factor of option pricing is volatility. Why volatility? Because expected price fluctuation of underlying asset, higher volatility means higher option prices. And the fourth one is interest rate as the key factor of option pricing. Why interest rates? Because impact the cost of carrying the option, higher rates generally increase call prices. And last but not least, in the key factor option pricing is dividend. Because reduce the price of call option, dividend makes stock less attractive for calls. Why? All the investor or the shareholder and the stakeholder use the option because the first one is hedging. Hedging is protect against a fast price movement. Option reduce portfolio risk. And the second one is why use option? Exactly the speculation. Why? Because the profit from anticipated price change, investor can bet on market direction and income generation earns premium by selling option. The strategy provides steady revenue. Yeah, because it's income generation. Are the shareholder, are investor using option for income generation because earn premium by selling option. And the fourth one is leverage. Why leverage has to be the why use the shareholder or stakeholder or investor use option because they control large asset position with smaller capital magnifies return on capital in leverage. In last but not least is exactly flexibility. Customized risk reward profile over option over tailored strategy. And the next one is the basic option strategy. For the basic option strategy consists of two parts. The first part is buying, and the second part is selling. Okay. And the first part in buying consists of four steps. Yes. The first step is buying cars. The second one is buying puts, and the third one is straddle and strangle. So, sir, what is the difference between straddle and strangle? So, the difference between both of them in straddle, buy both call and put, some strike or expiration. profit from large movement, and totally different with strangle, because similar to straddle, use out of the money option require larger price moves. So, buying calls and buying puts. For the buying calls, bet on price increases, risk is limited to premium paid, profit is unlimited. And buying puts, bet on price decreases, risk is limited, profit if asset falls. Okay. The second part of basic option strategy is selling. So selling and buying totally different. For the selling consists of two steps. First one is covert call and the second one is cash secure put. So what is the difference between both of them? So for cover call, selling a call option on stock you own generate income limit upset potential. And the second one is cash secure put because selling a put, setting aside cash to buy stock generate income obligation to buy. So this is the advanced option strategy, like a pyramid. Yes, Uh, and the top is the first one is iron thunder, and in the middle pyramid, and second one is butterfly or spread, and the lower of pyramid is ratio spread. In iron thunder strategy to profit from low volatility, it used for option for a specific range. Butterfly spread in the middle of the pyramids is limited risk, limited profit strategy. It's used for expecting small movement. And the last but not least is exactly in the fundamental of pyramid is ratio spread. Combines buying and selling option in different ratio, provide customers risk reward. And this is the option risk of option trading. Yeah, there are five option trading and option complexity. Option are more complex than stock. Yes, because option is really very complicated. So they are very complex than stock. They require advanced understanding. Yeah. Yeah, because in stock really easy, but in the option is really hard to understanding about the option. Okay. Early assignment, potential obligation to buy or sell asset. This can happen unexpectedly. Okay. And the third one is time decay or theta. Option lose value as expiration needs. This is a constant drag or profitability. Leverage magnifies both potential gains and losses. Small move can have big impact. And the last but not least is volatility risk or vega is option price sensitive to change in volatility. Unexpected swing can be costly. So this is the our okay. Okay. Okay, sorry because this is the signal issue in our faculty because signal is not supporting me to using Zoom application to give you transfer knowledge to you. Oh my God, the signal is okay. Wait a minute. I'm so sorry. It's so this is our conclusion for our final today. Uh, Option as a tool. So the versatile instrument, option over diverse application for investor. They are flexible and powerful. The second one is require understanding because deep knowledge and risk management are crucial. Education is key to success and enhance strategy. Option can significantly improve investment outcomes. They add strategy depth. And understanding, as I said before, because when we understanding stock option is crucial because this instrument offer strategic flexibility for speculation, hedging, or generating additional income with relatively small capital or the premium option provide a high leverage to control a large number of share while limiting risk for buyer to only the premium paid. An option also act as insurance for a portfolio. For example, a put option protect against losses if stock price fall, while allowing traders to earn premium by selling options such as through cars. Additional, the option market expectation of future volatility and prices. Aiding more informed decision making, however, their complexity require the understanding to avoid strategic errors, especially for options that face higher risk. By mastering option, investor can maximize profit, manage by mastering option, investor can maximize profit, manage risk, and also we say about capitalize an opportunity in uh, various market conditions. So by mastering about the option, investor and we all of them can maximize profit, manage risk, and capitalize an opportunity in various market conditions. So this is the option. Okay. I think that's all for today. Thank you for coming. Thank you for attending in my classes in the option, our subject, and the lesson of the capital market analysis. I'm very thank you to all of you. Nice to see you in other opportunity. And thank you. Assalamualaikum warahmatullahi wabarakatuh.
Waalaikumsalam
Waalaikumsalam
warahmatullahi
warahmatullahi
Waalaikumsalam
wabarakatuh.
warahmatullahi wabarakatuh. Thank you, sir.
See you in another moment. Okay.
wabarakatuh.